Understanding the lingo when it comes to option trading is going to be important because you want to, understand what you're reading, understand what you're looking at, and when you understand certain terminologies, you have a better chance with your trading because you know what to look for in specific manners. So tonight, I want to look at three little lingos that you probably hear and you may not fully understand, and that is ATM, ITM, and OTM. So let's get right into it. ITM means in the money. An in the money call option is just basically an option that is already profitable or a strike price that is already profitable. So let's just say you are looking to get into a call option, okay? And the stock price is $100. Now, calls mean you are looking for the stock to go up. So if you get into a in the money option, you will be looking for options that, well, strike prices that are lower than the current price. So if the stock price is $100, your in the money option could be $98. Okay, so if you're looking for the price to go up, that means you want it to go higher than $98. And if it's already $100, that just means that that option that you're selecting is already profit. And that's the exact same way if you're getting into a put option. If you are looking for the price to go down and the stock price is $100, but you pick 102 strike price, that is just basically saying that, okay, the strike price or target price is 102, but the stock that it's already at $100. You are hoping for it to go down. So therefore, this option is already in profit. Now, here's something to understand when it comes to in the money option. They are more expensive than ATM and OTM, and they have higher deltas. If you don't know what the delta is, the delta just lets you know how much the stock is going to move per dollar as the stock goes. So the higher the delta, the higher probability of profits. Now the second one, ATM. This means at the money. This one is just plain and simple. The strike that you're about to select is more than likely the exact same price as the stock price, or very, very close. So stock price $100. The at the money option is $100 even, $100.50, or may even be 99. Those strikes that are close, like really, really close to the current price of the stock, are what is referred to as at the money. So it's just like a neutral price, okay? Now, these also have some decent deltas as well, and they are encouraged to go for. Like a lot of times, everyone cannot afford in the money option. So you may want to kind of come to neutral grounds and go for at the money option so that you still have the possibility of a high delta and you have something that is close to the current price of the stock, whether you're in calls or put. Number three is OTM, out the money or out of the money. This one is one that has a strike price that is way further away from the current price. So if you got $100 stock price, okay, and you can't afford to do at the money or in the money, and I'll talk about what I mean by can't afford. So when it comes to out of the money, you are going further, further, and further away. Let's just say the stock price is $100 and you want to get into a put to say that this stock is going to go down to 80. That's a $20 drop. That is far out of the money. And that's basically you saying, I believe that this stock is going to drop $20. Or you're saying that I can only afford to do an $80 strike. Now, let's get into what I mean by the affording part. In the money options are more expensive than out the money and at the money. When you go out of the money, it's more than likely because you're trying to find something much cheaper to pay. Now, this is where the premium comes in. The premium is the cost that you pay to enter into the position. So if you're buying positions that are already profitable, more than likely they're going to cost more money. But when you're going further and further out of the money, you will be able to pay lesser. And out of the money options are just somewhat more attainable for some people, especially when you're new to trading. But there are low cap stocks that you can look at that have in the money and at the money options. That aren't so expensive. But when you try to go with the big boys like high volatility stocks or stocks that have extremely high premium and you really want to trade it and you say, okay, I only have about $50 to $100, but these premiums are costing $300, $400, $500. So I got to go further down the option chain to find something that's a lot cheaper. You will notice that the strike price may be, the strike price from the current stock price is much different. It's like a huge difference the further down that you go. So quick tip, when it comes to out of the money, when you get an out of the money option, this needs to be a long game unless this stock makes extremely massive moves, whereas you can see some profits within a few days, which such as like 7 days or maybe 2 weeks. If you are going to go extremely out of the money, you need to have a higher expiration date so that you have time to hold your position much longer to give that stock time to make some moves. Out of the money options are not currently valuable. They are no value as of now until the price starts to get closer and closer to that strike price. Now, the fourth one is a bonus one, which is Deep ITM or DITM, which means deep in the money. It is just like in the money, but you're just going deeper, meaning that the premiums are going to be much higher. Okay, so whether you're in calls or puts, when you go in the money, the further in the money you go, like deeper in the money, it becomes DITM. Okay, this is just basically saying you are finding premiums or you're finding strike prices that are extremely valuable already, and you're just going to continue to capitalize a little bit more on that position. But it is just like in the money, you're just going further and further out to find more valuable ones. That means that the price on the strike is far away from the current stock price, and that's just up to whatever which way you're playing, calls or puts, up or down. Okay, so you have in the money, at the money, out the money, and deep in the money. These are four terms that you just need to understand when you are looking at the option chain, so you'll understand how to better pick your strike price. So if you're new to this, I hope that this helped, and I hope that these were four terms that you may have heard, or you may have heard the abbreviations of them, and you didn't quite understand what they were. Use these to take with you on that option chain so you can help. Well, it's just the first part of, helping you pick a great strike price, but for the most part, it is the basic terminology to help you know and understand what those numbers mean on the option chain.